Hello, my name is Matthew Franz, and welcome to Business Analyst Reporting for Accountants. In this series, we're breaking down the skills accountants actually need to think like business analysts. Not just recording numbers, but using them to explain what's happening in a business and predict what might happen next. If you're studying for the CPA bar exam, this content is built to help you connect the technical material to real-world decision-making. We'll cover topics like budgeting, forecasting, variance analysis, and performance reporting, and more importantly, how companies actually use these tools to run their operations. The goal here isn't to just help you pass the exam, it's to help you understand how accounting data turns into business insight. Let's get started. Hello, I'm Matthew Franz, and welcome back to Business Analyst Reporting for Accountants. Today is day 2, Variance Analysis, the most important day of our series. Yesterday we learned the basics of manufacturing costs, direct materials, labor, and overhead. Today we are going to dig into why numbers changed. Not just the numbers themselves, but the story behind them. Variance analysis is like detective work for finance. Imagine you have a budget or a standard cost. Variance analysis helps you figure out why your actual costs were different. And that's what separates a good analyst from someone who just reports number. Let's start with materials, because almost every product starts with raw materials. There are two main types of variances here, price and usage. Material price variance measures the difference between what you actually paid for materials and what you expected to pay. Let's suppose we plan to buy steel at $5 per unit, but the supplier charged $6 per unit. If we bought 1,000 units, the variance is $1 times 1,000 equals 1,000 unfavorable. Did the suppliers raise prices? Did we miss a bulk discount? Are raw materials scarce? That's the story this variance tells us. Material usage variance measures whether we used more or less material than we expected for production. Let's say we plan to use 100 units of steel per product, but actually used 120 units for the same output. That's an unfavorable usage variance of 20 units times $5 equals $100. This can point to waste, spoilage, mistakes in production line, or inefficiencies. Unlike price variance, which is purchasing related, usage variance is production related. Always remember, price variance tells you about suppliers, usage variance tells you about operations. Both are important, but they answer different questions. Next, let's look at labor variances. Like materials, there are two key types, rate and efficiency. Labor rate variance is the difference between actual wage rate paid and the standard rate expected. We expected $20 per hour, but actually paid $22 an hour. If 500 hours were worked, the labor rate variance is $2 times 500 equals $1,000 unfavorable. Maybe overtime was required. Maybe we hired higher skilled employees. Or maybe labor laws or union contracts caused a change. Labor efficiency variance looks at the number of hours worked versus the number expected for the output produced. We expected 50 hours to produce 100 units, but it took 60 hours. An extra 10 hours times $20 equals $200 unfavorable efficiency variance. This could be training gaps, unproductive time, machine downtime, or process inefficiencies. Rate variance equals HR or pay issues. Efficiency variance equals operational issues Always separate the pay story from the process story. Finally, let's talk about overhead. These are the costs that support production but aren't direct materials or labor, like electricity, rent, or factory supervision. There are two main variances here, spending and volume. Spending variance shows whether you spent more or less than expected for overhead costs. Let's say we budgeted $10,000 for electricity but spent $12,000. That's a $2,000 unfavorable spending variance. Could it be higher utility rates, maintenance costs, or unexpected repairs? This is about cost control and not production quantity. Volume variance shows us the impact of producing more or fewer units than planned. Let's say we allocated $50 per unit for overhead. Planned production equals 200 units, which would be $10,000, but we made 220 units. Allocated overhead equals $11,000. Volume variance equals $1,000 favorable. This shows how efficiently we use capacity. Producing more spreads fixed costs over more units. Producing less does the opposite. Spending variance equals did we control costs. Volume variance equals did we hit production goals. Both together tell you if overhead is working efficiency. Let's quickly summarize for materials, labor, and overhead. We now know why costs change, not just the numbers themselves. Materials, price and usage. Labor, rate and efficiency. Overhead is spending and volume. Variance analysis isn't just about math, it's about asking the right questions. Why did this happen? And what can we do to fix it? Always look for the operational story behind each variance. That's the insight that makes you a real analyst. Next, try this on your own. Pick a product or service, calculate variances, and dig into why costs were higher or lower than expected. It's the best way to see these concepts in action. Next, let's do some multiple choice, which would be questions from your bar exam. Question 1. A company expected to pay $8 per unit of copper for 1,000 units, but actually paid $9 per unit. What type of variance is this, and is this favorable or unfavorable? Well, it's a material price variance. Price variance equals actual price minus standard price times actual quantity. So the actual price was $9, which is greater than the standard price of $8. And that makes it unfavorable because the company paid more than expected. Question 2. A factory planned to use 500 pounds of steel for production, but used 600 pounds. The standard cost is $10 per unit. What does this indicate? Well, usage variance equals actual quantity minus standard quantity times standard price. Using 600 pounds instead of 500 pounds indicates inefficiency in production or waste. This is unrelated to price or labor. So B, production used more material than was expected. 3. An employee was expected to be paid $25 per hour, but was actually paid $30 an hour for 100 hours worked. What is the labor rate variance? Well, the labor rate variance equals actual rate minus standard rate times the actual hours. This equals $30 minus 25, which is a $5 difference, times 100 hours. So 5 times 100 is $500, which is C or B, $500 unfavorable? It's unfavorable because actual rate was greater than standard rate. Question 4. A company plans for 40 hours of labor to produce 100 units, but employees work 50 hours to produce the same output. How should management interpret this variance? Efficiency variance equals actual hours minus standard hours times the standard rate. The actual was greater than the standard, so that means it's unfavorable. This points to slower work or inefficient processes, not pay rates or materials. So B, production processes may be inefficient. Five, a factory budgets $15,000 for electricity, but actually spends $16,200. This variance is unfavorable because it's higher than expected costs. Next, let's dive into the Excel spreadsheet we created yesterday. We're going to take the manufacturing cost data we learned yesterday and add variance analysis and a flexible budgeting. This is how cost analysts figure out why actual costs differ from expected costs. And it's exactly the type of thinking tested on the CPA bar exam. By the end of this video, you'll be able to calculate and interpret material, labor, and overhead variances, and even test different production scenarios in Excel. Quick recap. Yesterday we learned how costs flow through a factory, from raw materials to work in progress to finished goods, and then to cost of goods sold. And how costs behaved. We had fixed, variable, and mixed. And there's also another thing we haven't really touched on, which was step costs. We also learned about cost drivers, labor hours, machine hours, and units produced, and different setups. Let's look at, here's what cost analysts start, comparing what we expected to spend to what actually happened. You'll notice some costs are higher and some are lower. So what we're going to do is add two new columns, an actual and a standard, and this is direct material, direct labor, and overhead. So for direct material, we had 30,000, which was a standard, and 32,000, which was our actual. So this is a $2,000 unfavorable because we spent more. For direct labor, we had actual at 19,000, and the standard is 20,000. So this is favorable because we saved 1,000. We spent less than expected. And for overhead, we had 17,000 at actual, and standard was 15,000, and this is a $2,000 unfavorable because we spent more than expected. You notice some costs are higher and some are lower, and each tells a story. Now we can see the difference numerically. We also put in conditional formatting. So if you go to conditional format and you go greater than 0, which is unfavorable, we want it as red. And if it's less than 0, it'd be a green because it's favorable. Conditional formatting makes it easier to see which areas need attention. You don't have to hunt through the numbers. Red flags the problem and green shows the efficiency. Now let's move on to production assumptions. We can use this to test scenarios. What if production increases from 10,000 to 12,000 units? Variable costs increase, fixed costs per unit decreases. This is exactly how cost analysts prepare flexible budgets and advise management. So what we did here was we took from the manufacturing cost flow, we took this number, but we didn't use raw materials because this hasn't been used yet. So we used the 68. So this is 68,000. And then we used this and this for each of the direct materials, direct labor, and machine overhead. So we took that amount, which was from the manufacturing cost flow sheet, that was 68,000, and then we took it divided by the units produced, which is 10,000. And the same here, direct labor, we took, which was 49,000, and we divided by 10,000, and that gave us a price of $490 per unit. And machine overhead was $340 per unit. And then here was the total cost per unit. Now, let's say we want to change this to 12,000 because that's what we produce. It automatically changes. And this is how your flexible budgeting works. So the key takeaway here is this. Manufacturing cost reports don't magically create answers. They organize information so decision makers can ask better questions. Units produced are operational inputs. Costs flow through raw materials, work in progress, finished goods, and eventually cost of goods sold. Understanding where costs sit and why is what allows analysts to explain variances, build budgets, and support management decisions. In the next video, we'll build on this foundation by introducing more flexible budgeting and showing how changes in volume affect per unit costs and financial reports. I hope if this was helpful, like the video, subscribe for more bar-focused accounting breakdowns. And I'll see you in the next one. And here are the 10 bar style questions that we reviewed in Day 1 Cost Foundations. And if you want to pause this as you go, you can pause it and read these and study them. Thanks for watching this session of Business Analyst Reporting for Accountants. I hope you found it helpful in connecting accounting concepts to real-world business analysts. If you're studying for the CPA bar exam, remember, understanding the why behind the numbers is just as important as knowing the rules. Keep practicing, reviewing, and applying these concepts. That's how you turn knowledge into insight. Don't forget to like, subscribe, and hit the notification bell so you don't miss future videos. And if you have any questions or topics you want me to cover, drop them in the comments. I'll make sure to get to them. Until next time, keep analyzing, keep learning, and stay curious.